From the Wall Street Journal, signature loan sale likely to lower commercial property values. Sale of Signature Bank's $33 billion in commercial property loans and other assets is expected to attract bids as much as 40% below face value. Regulators closed Signature Bank in March after a run on its deposits, marking the fourth largest bank failure in U.S. history. Now the Federal Deposit Insurance Corp is auctioning off thousands of signature loans backed by apartment buildings and other commercial properties, primarily in the New York region. Loans are expected to sell on average 15 to 40% below their original face amount, according to prospective bidders. Those discounts will likely affect values of New York commercial property for a number of years. Signature's loan sale will provide an alien commercial real estate market with one of the clearest benchmarks for how badly values have been eroded by the jump in interest rates and weak return to office rate. The pools from Signature attracting the most attention from the private equity firms looking to purchase consist mostly of loans in office buildings, retail properties, hotels, and non-regulated apartment buildings. They have a combined debt value of about $16 billion. Scores of firms have reviewed bidding materials. Those include Blackstone, KKR, TPG, and Goldman Sachs, major players in private equity. So far, property sales have been light, largely due to owners not wanting to sell into a weak market. Investors it's only $89.2 billion used commercial property in the third quarter. That's a decline of 53% from the same period last year. Most of Signature's loans are performing. Nevertheless, the FDIC and New York Group, the real estate firm running the sale, are going to have to sell them at discounts, partly because they were made when interest rates were a lot lower than today. And the investor would want a discount to buy a loan paying a 6% interest rate if comparable debt issued today is paying 9%. Some of the loans were for lackluster mid-block office buildings in Manhattan, which are suffering high vacancy rates because of the work-from-home trend of the pandemic. Just how far values have fallen on these properties is difficult to pinpoint, but at some buildings where all apartments are regulated, values have fallen as much as 70%, according to the Community Housing Improvement Program. The FDIC has said it plans to retain a 95% stake in the pools with a rent-regulated loan portfolio, partly because of its statutory obligation to preserve affordability for low and moderate income renters. So although the headline here is Signature loan sale likely to lower commercial property values, as we get into the article, we do find that this is mostly linked to certain areas in New York, certain classes of properties in New York. Nevertheless, for those markets, it is likely to establish lower comps, but it would probably be an overstatement to imply this means a fall as much as 40% for all commercial property values, despite the subhead of the article here. Nevertheless, the sale, again, will give some good price discovery information in a particular metro with a few particular classes of properties.